Well, Asian markets, they trade higher ahead of that crucial meeting between President Donald Trump and Chinese leader Xi Jinping at the G20 summit, which many are hoping for that will help ease trade tensions between both those two nations. Asia, remembers, also tracking the up move that we saw on Wall Street, which was spurred by remarks coming in from Fed Reserve Chairman Jerome Powell on the slower pace of rate hikes going forward. For starters, you have the Nikkei that's opened up the gain of around 0.8%. There is some strength actually on the dollar yen, but yet in fact we're seeing that market hold up despite the fact that holding with a good gain. And you also had the other couple of markets. Both the Straits and the Taiwanese index had opened up with a gain of around 1%. So if everyone's opening up with a gain of around 1%, the SGX Nifty is saying, hey, even I'm in there with an opening at least at around above the 10,800 odd mark. Going to be interesting to see what happens from there because it's expiry day. And if you have an opening like this, some of those bears will be very, very nervous. So we'll keep an eye out on that front as well. But moving on, then a dovish tone from Fed chair fueled speculation that the central bank is closer to pausing on rate hikes. In a speech at the Economic Club of New York, Powell said the policy path, suggesting that the central bank's steady rate of interest rate hikes could slow down in the coming months. CNBC's Sri Jagaraja analyzes what the comments could mean going forward.
It's interesting because the big call from this summit from Morgan Stanley is underweight US equities in 2019 and a very strongly held perception that emerging markets are going to come storming back. So perhaps that will start playing out on the emerging market side, especially if the dollar remains low. But you've got to consider what happened overnight, this very dramatic turnaround in the stock market. So you've got to ask yourself the question whether Morgan Stanley now really have to rip up the script and perhaps get a little bit more positive towards US equities as we head into 2019, if we do now have a Powell put. And now it is only just a 1 day, but on the face of it, it looks as if Chairman Powell, from his comments about just below with regard to the neutral rate, seems to have put a floor in the market. It is just 1 day, but the market seems to have liked what they've heard from a more dovish Powell. This is what Chairman Powell had to say.
Interest rates are still low by historical standards, and they remain just below the range of estimates of that low for the economy. That is neither speeding up nor slowing down growth. The unemployment rate is 3.7%, a 49-year low, and many other measures of labor market strength are at or near historic bests. Inflation is near our 2% target, and the economy is growing at an annual rate of about 3%, well above most estimates of its longer-run trend. The health of the economy gradually but steadily improved, and about 3 years ago, the FOMC judged that the interests of households and businesses, of savers and borrowers, were no longer best served by such extraordinarily low rates. We therefore began to raise our policy rate gradually toward levels that are more normal in a healthy economy.
Well, these are the comments that made the Dow rally over 600 points. The U.S. markets rallied on Jerome Powell's dovish tone. Now, Dow rose more than 2.5%, posting its biggest one-day gain since March 26. The S&P 500 jumped over 2%, while the Nasdaq advanced almost 3%, rose sharply, recovering from this recent steep losses that we have been seeing. CNBC's Eric Shemi gets us a wrap of all the action on Wall Street.
U.S. stocks soaring in today's trading. The Dow adding 617 points, up 2.5%. The S&P up 61, and the Nasdaq higher by 208 points, nearly 3%. Those moves coming thanks to comments from Fed Chair Jerome Powell. Speaking at the Economic Club of New York, Powell saying that current interest rates are close to neutral. That's a change in tone from his recent remarks, and traders took the comments to mean that we could see fewer interest rate hikes from the Fed next year, a good indicator for the stock market. A key indicator for the housing market, though, bullish. New home sales for October plummeting 8.9% thanks to rising mortgage rates. The number of newly built homes sitting on the market hitting its highest number since back in January 2009. The median sales price for a new home also dropping 3% from a year ago. And oil prices falling another 2.5% today to just over $50 a barrel. That after U.S. crude inventories rose for the 10th week in a row. Crude prices have collapsed since the summer, now down more than 30% in the last 2 months. That's the action from the U.S. market. Back to you in Mumbai.
Okay, so the Fed chair, is giving a suggestion that perhaps next year we might be seeing fewer rate hikes, and that's the reason the U.S. markets rallied. In fact, let's listen into some opinion coming in from Goldman Sachs as well as BlackRock on what they had to say about the road going forward for the U.S. markets.
We are draining so much liquidity. It's the draining of that. So do I think the Fed can slow down the reduction of the balance sheet? Yes. It's underneath the surface. You can't tell. The reason why liquidity is so difficult today is the Fed is reducing the balance sheet, the ECB is reducing the balance sheet. By the way, the Treasury is issuing a net $1 trillion a year of additional debt, draining liquidity from the system, and that's why you're seeing assets go out of equities, or people go out of equities, people go out of some of the debt markets, right into the front end of the yield curve because they're draining so much liquidity from the system. So do I think the Fed should slow down the reduction of the balance sheet? I do. See crises hit in places like in Argentina, like Italy to some extent. The pressure on liquidity in markets today is really difficult because you're draining so much from the system around the world. I think the Fed is hugely important today. And I think that dynamic of where we're going in rates, where we're going in liquidity is a dramatically important thing. Listen, Chinese growth, you're saying two things that are hugely important. If you said to me what is third, it's hard coming up with what is third because Chinese growth is dramatically important to the system globally. And they're doing an awful lot to try and stabilize their growth. I think the base case is you're going to have, we had a good set of meetings. We are going to negotiate from here, and I think the markets will like that. So we've added a bit of risk going into next week.
The broad thrust of business activity is still reasonably positive, and the commentary from corporations remains positive. The individual balance sheets of consumers remain strong. That's 70% of the activity in the country. So that's the fundamentals we look at. From an interest rate perspective, it is an area that we're focused on. The expectation is that the 10-year bond yields will rise to something around 3.5% at the end of next year. So that's an issue that has more pertinence for valuations. The broad central thrust and the central case is that we're not, and the economy continues to grow at a decelerating rate in 1920, and that would be consistent with the market staying around these levels in multiple terms, and therefore the earnings growth would take you higher.
Well, European markets, they ended lower around the flat line ahead of the Fed chair's speech. But the main focus really is going to be on the G20 summit, where President Donald Trump will meet Chinese Premier, and there is hope of a potential truce in the US-China trade dispute. So ahead of that, that market, all the three markets, in fact, ended more or less flattish.
Okay, let's take a look what's happening in the world of currency, because the dollar has actually dipped below the 97 mark, and that as Fed Chair Jerome Powell says rates are nearly come to an end faster than initially anticipated.
And in the world of commodities, Brent crude prices fall below $60 per barrel mark as US crude stockpiles rose more than expected after falling to a 2.5-year lows in September. Now, crude stocks have risen by 14%, with 10 straight weeks of increases adding to worries about a return of worldwide supply glut. All eyes now on December 6th, where members of the OPEC are likely to meet and discuss supply curbs to the tune of around 1 million to around 1.4 million barrels per day.